Stop. Before you scroll past this video, before you check another frantic price alert on your phone, and before you retreat into the white noise of the daily news cycle, I need you to stay with me for the next few minutes. I'm going to give you a single number today. It is not a stock price, it is not a political poll, and it is not a marketing gimmick. It is a number that will fundamentally alter how you perceive every dollar you currently earn, every cent you save, and every choice you make about your financial future. On this Sunday, April 26, 2026, the scoreboard of the global economy looks like this. Silver is trading at $75.30 per ounce. Gold has climbed to a staggering $4,183.60. Meanwhile, the mainstream financial media is performing its usual choreographed dance, pointing you toward the exit at the exact moment of maximum opportunity. They are fixated on the nominal world, the world of digits on a screen that grow larger while their actual power withers. But here's the number I promised you. 2,200. That is the precise quantity of silver ounces at the next major price target for this metals bull market that will be required to purchase a median-priced home in the United States. Not the dollar price of silver, not a complex chart pattern, and not a speculative mining ratio. I'm talking about the actual physical weight of metal you will need to walk into the real estate market and settle a transaction in full, without a mortgage, without a bank, and without 30 years of interest payments bleeding the life out of your household. To understand the gravity of that number, you must look at its twin, 5,400. That is the number of silver ounces required to buy that same median American home right now, at today's prices. The distance between 5,400 and 2,200 is not a fantasy, nor is it a prediction from someone trying to sell you a miracle cure. It is the cold, mathematical output of a framework that has been quietly grinding away since the year 2000. A framework that is accelerating in 2026 in ways the data is now screaming at anyone willing to look. Why does this matter? Because we are living through a grand illusion. Most people measure their wealth in dollars, but in 2026, measuring your life in dollars is the equivalent of measuring a distance with a rubber band. The unit itself is elastic. It stretches at the whim of a committee in Washington. The number on the band changes, but the underlying reality stays the same, or worse, it shrinks. When the currency is being produced at scale, hard assets don't necessarily get more expensive. The currency simply becomes less capable of claiming them. By the end of this analysis, you will understand not just that silver is moving higher, but precisely how many ounces you need, exactly when the final accumulation window closes, and why the people waiting for a traditional rescue are about to be left behind. This is the math lesson the financial media does not want you to sit through. It is a story about the death of debt and the rebirth of atomic reality. I didn't start tracking the relationship between precious metals and real estate because it was fashionable. In fact, back in 2023, when I first urged the people on this channel to save in gold and silver as a path to home ownership, it was an outlier position. The Federal Reserve was still aggressively hiking rates, metals were being dismissed as pet rocks, and the consensus was that the dollar was invincible and housing was resilient. 3 years later, that conventional wisdom has been demolished piece by the very data we are looking at today. The claims I'm making are plain. The United States is already in a recession. It's not approaching one, it's not on the verge, it's here. The official probability models might show a 25.5% chance of a downturn in 2026, but those numbers are mere theater, a statistical hedge by institutions that have no incentive to tell you the truth until it's too late to act. Here is the actual signal, the one that has never lied in the historical record. Median home prices in the United States have been falling for 3 consecutive years, from a peak of more than $442,000 at the end of 2022 to approximately $407,000 today, a structural decline of more than 8%. Home prices do not fall for 3 straight years in a healthy economy. It simply does not happen. The current administration has no interest in owning a recession narrative that technically began under its predecessor, and that political reality is filtering the data being presented to the public. But you don't need a government press release to confirm what the most important domestic asset class is telling you. The dominoes are already falling. The only question is how many ounces you've managed to catch before they finish. We are at a crossroads where the why and the how become more important than the what. Why is the gap between 5,400 ounces and 2,200 ounces closing so rapidly? It's because the system is reaching a point of technical exhaustion. We are witnessing a fundamental repricing of what it means to own something. Is an asset truly yours if it requires 30 years of tribute to a banking institution? Or is ownership something that should be measured in the weight of an element that cannot be printed, debased, or deleted? The 2,200 number represents more than just a financial target. It represents an exit ramp from a system built on the perpetual expansion of paper claims. It is the price of sovereignty. As we move forward, we will dissect the mechanics of this rotation, from the shifting strategy of central banks to the specific calendar dates that define the final accumulation window. The window is still open, the price is still rational, but the clock is ticking. Are you counting in dollars or are you counting in ounces? To understand why the current economic landscape feels like a hall of mirrors, we must step back from the flickering charts of 2026 and examine the structural tectonic plates that began shifting decades ago. The story of our current crisis is not one of a sudden shock, but of a slow-motion decoupling, a divorce between the world of paper claims and the world of physical reality. To grasp the why behind the 2,200-ounce silver target, we must first analyze the era that defined the paper mirage. Cast your mind back to the year 2000. It was the absolute zenith of the dot-com era, a time of unbridled optimism where new economy paradigms suggested that physical constraints no longer applied to wealth. At that peak, a median-priced American home cost nearly 600 ounces of gold. In the silver market, the dismissal of hard assets was even more extreme. Silver was viewed as an industrial afterthought, so thoroughly stripped of its monetary dignity that it took a staggering 36,000 ounces to buy that same median home. This was the paper era at its most exuberant, a time when confidence in U.S.-led financial institutions was so absolute that the unit of account was the only thing investors cared to count. But markets have a way of enforcing reality. Between 2000 and 2011, the first great repricing of the century occurred. Following the destruction of the global financial crisis, the illusion of the paper-only economy shattered. By 2011, that same median home didn't cost 600 ounces of gold anymore, it cost just 119 ounces. In silver terms, the requirement collapsed from 36,000 to 4,600 ounces. This wasn't merely a price move, it was a fundamental shift in how the world valued real assets versus financial promises. The metal had effectively consumed 80% to 90% of the home's overvaluation in a single decade. Yet, here's the nuance the mainstream media consistently misses. What happened during the lost decade of metals between 2012 and 2023? During those years, we saw a long, grinding bear market for gold and silver, while housing prices, fueled by the cheapest credit in human history, soared to new nominal highs. A casual observer would say that housing had recovered. But look at the leaderboard denominated in ounces. Even during the height of the post-2012 housing boom, the price of an American home, when measured in gold and silver, never once recovered to its pre-2008 levels. Not in 11 years of a metals bear market, not even close. Before the 2008 crisis, a home cost roughly double the gold it did in the years following the recovery. This reveals a structural scar on the global economy. Once the world began questioning the integrity of paper claims after the Lehman collapse, the ounce standard established a new, lower ceiling for real estate that has never been breached since. So, why are we seeing this acceleration in 2026? To find the answer, we have to look at the S&P 500 to silver ratio. This is the ultimate barometer of trust. At the peak of the 2000 bubble, the S&P 500 cost nearly 300 ounces of silver. By 2011, it fell as low as 36 ounces. Today, after a rotation that began building in 2024, the ratio sits at approximately 95 ounces. This means that nearly half of the rotation from equities into hard assets has already occurred, yet we are still nowhere near the floor of the last cycle. The deep context here is that we are in the middle of a multi-decade great rotation. We are moving from an era defined by the expansion of credit and digital entries back to an era defined by geology and tangibility. The underlying factor is a phenomenon I call institutional exhaustion. For 25 years, central banks have managed every crisis by expanding the supply of the unit of account, the dollar. But you cannot solve a shortage of physical homes or a shortage of industrial silver for the green energy transition by printing more units of account. In a healthy economy, prices rise because demand is high and people are productive. In our current 2026 environment, prices are staying elevated because the currency is being debased faster than the asset can fall. This is why the recession narrative is so confusing to the average person. They see their home value sitting at $400,000 and think they are wealthy. But that is the rubber band measurement. If you look at that same home and see that it is now worth 86 ounces of gold instead of the 227 ounces it commanded just 4 years ago in 2022, the reality becomes clear. The value is leaking out of the asset and into the metal. The historical parallels are undeniable. We are retracing the path of the 1970s, but with 10 times the debt and half the industrial capacity. The period from 1990 to 2023 was an anomaly. A long paper summer, where we forgot that wealth must eventually be anchored to something the government cannot conjure out of thin air. As we enter the hard winter of 2026, the market is simply returning to its historical mean. The question isn't whether the dollar price of your home will crash by 50%. The question is whether you are prepared for the ounce crash. where your home loses 60% of its value relative to silver while the nominal price tag stays exactly the same. The history of the last 26 years tells us this isn't just possible, it is the primary mechanism by which the market clears its excesses. The path to 2,200 ounces isn't a new road. It's the completion of a journey that began when the first .com server went dark. To understand why the repricing of the world is inevitable, we have to look under the hood of the global financial engine. Economics is often presented as a series of chaotic, unpredictable events, but in reality, it functions more like a hydraulic system. When you apply pressure to one end, through currency creation, the fluid must go somewhere. In 2026, that fluid is flowing out of paper and into the atomic reality of silver and gold. To see the how, we must break down the three mechanical pillars currently holding the market in a state of terminal tension. The first pillar is the balance sheet paradox. As of this week, the Federal Reserve has been expanding its balance sheet for 9 consecutive weeks. In a vacuum, this might seem like a technical adjustment, but it is occurring while the personal consumption expenditures, PCE inflation reading, is projected to hit new 12-month highs. Simultaneously, oil, the master resource that dictates the cost of every physical good, is up more than 60% on the year. This is the hydraulic trap. Ordinarily, high inflation forces a central bank to contract its balance sheet to sap liquidity. But the Fed is doing the opposite. It is injecting liquidity into a system that is already overheating at the source. This creates a divergence between nominal interest rates and real interest rates. Even if the Fed keeps the headline rate high, the accelerating rate of inflation means that the real cost of money is plummeting. When real rates are negative or falling, capital doesn't just walk toward hard assets, it runs. The second pillar is the nominal floor of residential real estate. This is the mechanic that most retail investors get catastrophically wrong. There is a prevailing emotional desire for a 50% crash in the dollar price of housing, a longing for justice in an unaffordable market. However, a 50% nominal collapse in the largest domestic hard asset class is structurally incompatible with a central bank that is expanding its balance sheet by the billions. Think of the dollar price of a home as a buoy in a rising tide. The buoy isn't growing, the water level is rising. The government has an arsenal of tools to prevent nominal price collapses. They can extend mortgage amortizations to 40 or 50 years. They can subsidize interest rates for specific buyers, or they can simply debase the currency until the $400,000 price tag feels cheap relative to a gallon of milk. This is the playbook used after the savings and loan crisis and after 2008. The result is a housing market that remains stubbornly priced between $390,000 and $450,000 in dollar terms, while its actual value is being hollowed out from the inside. The third pillar is the silver spring, the technical and industrial compression of the metal itself. Silver currently sits at $75.30, but it is being held back by a final structural resistance level. The 200-day moving average, DMA, is the anchor for institutional algorithms. Currently, that average sits at 61.28 and is rising every single day. Based on the current trajectory, this anchor will meet the February structural low of $64 by late May or early June. This creates a layered support zone. In any healthy bull market, the asset must return to its 200-day moving average to flush out the weak hands. The retail investors who bought at the top and lacked the conviction to hold through a 15% dip. This flush is the ignition sequence, while the media will use a potential drop to $64 to declare the death of silver. The mechanics tell a different story. It is the final coil of the spring before the July pivot. Why July? Because the institutional calendar is already set. Jerome Powell's final meeting on April 29th is the last gasp of the hawkish era. Powell, operating under adversarial political conditions, is likely to emphasize inflationary risks, providing the fear narrative needed to drive the final technical pullback in metals. But he is a lame duck. The incoming chairman, Kevin Walsh, is publicly committed to a different path: rate cuts. The transition from Powell to Walsh is a masterclass in political theater. Powell takes the blame for the final months of high rates and stalling metals, giving Walsh the cover to announce cuts in July under the guise of supporting the economy, during the very recession the data says is already here. When those cuts arrive, the hydraulic pressure is released. The capital currently sitting in money market funds and high-yield cash, which will no longer be high yield, will flood into a silver market that is already facing a physical supply crunch. The math of the convergence is then simple and brutal. If the median home stays in its nominal floor range of $400,000 and silver reaches its next confirmed target of $175 per ounce, driven by the Walsh pivot and the rotation out of an overvalued S&P 500, the ratio hits 2,285. Round it to the nearest waypoint and you have your 2,200 ounces. The metal does the heavy lifting. You don't need a banking collapse. You don't need the world to end. You simply need the mechanical relationship between a debased unit of account and a finite physical element to reassert itself. We are moving from a world where wealth was a digital promise to a world where wealth is a physical weight. The gears are already turning. The only variable left is the timing of the final entry. The consequences of this hydraulic shift do not stop at the borders of the American real estate market. We are witnessing a global repricing of power, one that is being masked by a sophisticated layer of narrative warfare. To understand the ripple effect, we must look at the entities that move first and talk last, central banks and sovereign wealth funds. In the fog of a recession, the distinction between what an institution says and what it does is the difference between being a victim of the cycle or a victor. Take the case of the Turkish Central Bank, a microcosm of the great deception currently playing out on the world stage. Just 4 weeks ago, the mainstream financial press was flooded with a uniform narrative. The precious metals bull market was over. The catalyst? Reports that Turkey was selling its gold reserves. The headlines were breathless, designed to create a selling pressure that would shake the confidence of retail investors globally. Yet, in the shadows of that very narrative, the reality was the exact opposite. In the past 2 weeks alone, Turkey reversed course, quietly purchasing 1.2 million troy ounces of gold as it closed its US dollar swap positions. This is not a minor inconsistency. It is a fundamental lesson in the weaponization of financial data. The purpose of the bear narrative was not to inform the public, but to manage them. It was to create an entry point for institutional accumulation by clearing the field of retail competition. Why is a nation like Turkey, and by extension, the broader global south, moving so aggressively into atomic reality? Because they have realized that the dollar is no longer a neutral store of value, but a political tool. The ripple effect of 9 weeks of Fed balance sheet expansion is the silent erosion of the rules-based order in favor of a reality-based order. In this new order, the winners and losers are being sorted by their choice of leaderboard. On one side, you have the dollar counters, those who view their wealth through the lens of a currency that has lost 8% of its purchasing power against housing in just 3 years. These are the individuals and nations holding paper claims, treasury bonds, and digital entries. On the other side, you have the ounce counters, the central banks of the East, the land-rich elite, and the savvy individual investors who have recognized that the unit of account is broken. The winners are already visible if you look at the tangibility premium. Consider the performance of farmland. Since 2005, while the median U.S. home has risen a modest 66% in dollar terms, the price of farmland has surged by 170%. Why the massive disparity? Because developed real estate is a hybrid asset. It is part physical land and part credit-sensitive structure. Farmland, however, is pure tangibility. It is an asset that requires no power grid to exist, no counterparty to remain solvent, and no policy decision to maintain its value. It is, like silver, a fixed geological reality. The global shift we are navigating is the transition from policy-driven wealth to geology-driven wealth. For the last 15 years, the winning trade was to own anything a central bank could manufacture in unlimited quantities: dollars, bonds, and credit-inflated tech stocks. This was the era of easy money, where value was a derivative of low interest rates. But as we sit in April 2026, that era is dead. The coming decade belongs to the things that no committee in Washington or Brussels can conjure into existence: land, silver, and gold. This shift creates a brutal ripple effect for the middle class. While the wealthy transition their holdings into hard assets, the average family is encouraged to stay in high-yield savings accounts or resilient stock indices. But high yield is an illusion when inflation is accelerating faster than the interest rate. If you are earning 5% in a bank account while the assets you actually need, like a home, are being repriced in silver at a rate that requires 3,000 fewer ounces, you aren't saving wealth. You're watching it evaporate in real time. Geopolitically, this is the great de-risking. Nations are no longer content to hold their national reserves in the liabilities of another country. They are counting in ounces, because an ounce of silver in a vault in Ankara or Shanghai is a sovereign reality that cannot be canceled or frozen by a digital stroke. The industrial consumption of silver, driven by a global energy transition that is physically impossible without element number 47, is the secondary ripple that ensures this isn't just a monetary event, but a physical one. The losers in this scenario are not just those who lose money, they are those who lose time. The families waiting for a 50% nominal crash in housing are waiting for a ghost that will never haunt this inflationary environment. They are sitting on a rubber band currency, waiting for the buoy of home prices to sink, while the tide of currency debasement is only rising. The crash is already happening, but it is invisible to those who refuse to change their unit of measurement. The question for the global investor in 2026 is simple. Who are you following? Are you following the narrative provided by the media to facilitate institutional entry, or are you following the footprints of the 1.2 million ounces moving into sovereign vaults? The leaderboard of the 20th century was denominated in paper. The leaderboard of the 21st century is denominated in the periodic table. The ripple has started. The wave is next. We have spent this journey dissecting the mechanics of a system in transition, peeling back the layers of a global economy that is increasingly detached from the ground it stands on. But as we reach the conclusion of this analysis, we must move beyond the charts and the moving averages to confront a singular philosophical truth. Wealth is not a number on a screen. It is not a promise from a government, and it is certainly not a digital entry in a brokerage database that relies on 1,000 invisible counterparties to remain solvent. Wealth, in its most honest and enduring form, is sovereignty over the physical world. The number we started with, 2,200, is more than a financial target. It is a waypoint in a return to sanity. For over a generation, we have been conditioned to measure our progress in a unit of account that is designed to fail. We have been told that a strong dollar is the hallmark of a healthy economy, even as the same dollar requires more and more of our labor to purchase the same square foot of land or the same ounce of silver. We have been living in a paper summer that lasted so long, we forgot that seasons actually change. But April 2026 is the turning of the leaves. The recession that the media treats as a statistical probability is, in reality, a structural reset. When home prices fall for 3 consecutive years in the face of massive currency expansion, the market is sending a clear signal. The collateral is being repriced. The era of credit-fueled expansion is being superseded by the era of tangible scarcity. This brings us to the final verdict on the housing-to-silver ratio. As we have seen, the path from 5,400 ounces today to 2,200 ounces tomorrow does not require a catastrophic collapse of the American suburb. It simply requires the inevitable that a currency produced at the speed of light loses value against an element produced at the speed of geology. At the eventual cycle blow-off top, where my targets see silver crossing the $200 threshold and gold exceeding $10,000, the ratio for a median American home drops even further to as few as 900 ounces of silver or 40 ounces of gold. Imagine that for a moment. At today's prices, 900 ounces represents roughly $142,000. In today's market, you are not buying a median American home for $142,000. But the families who learn to count in ounces today are the ones who will be transacting on those terms when the cycle completes. They will be the ones who exit the debt slave trap, purchasing their homes outright, without the 30-year interest burden that has become the modern equivalent of indentured servitude. The distinction between these two futures, the one denominated in dollars and the one denominated in ounces, comes down to a single decision point that is arriving in weeks, not years. The institutional calendar is printed in ink. The Powell speech on April 29th, the PCE data, and the technical convergence at the $64 floor in late May represent the final wide-open window for the retail investor. Once the Walsh pivot arrives in July, and the market realizes that the Fed has officially surrendered to inflation to save the banking system, the entry points you see today will vanish. They will become the "I wish I had" stories of the next decade. The skeptic will ask, why silver? Why now? The answer is found in the dirt. Recall the 170% rise in farmland compared to the 66% rise in housing. The market is already screaming its preference for that which cannot be manufactured. Silver is element number 47 on the periodic table. It has survived the fall of Rome, the collapse of the British pound's gold standard, and every fiat experiment in recorded history. It does not require a power grid to maintain its existence. It does not require a trust agreement with a central bank. It is atomic reality held in the palm of your hand. We are entering a decade where the winning trade is to own the things that policy cannot conjure. For 15 years, the world was obsessed with the how to print more, how to borrow more, how to manipulate the rate. For the next 10 years, the world will be obsessed with the what. What is real, what is physical, and what is truly mine? The crash the world is waiting for is already here. But it isn't a crash in the price of homes. It is a crash in the credibility of the paper claims used to buy them. If you are still measuring your distance with a rubber band, you will find yourself perpetually exhausted, running faster just to stay in the same place. But if you adopt the ounce mindset, the distance starts to shrink. The goal becomes attainable. The sovereignty becomes real. So as we close this analysis on this Sunday in April, I have one question for you. How many ounces are you targeting? At what point do you stop playing the dollar's game and start playing your own? The window is closing. The math is unambiguous. The unit of account is the strategy. Count in ounces. The future belongs to those who own the reality. This has been a deep dive into the mechanics of the 200-ounce home. If this framework has shifted your perspective, join the conversation below. Tell me where you are in your accumulation journey. Hit the like button to help this message reach those still trapped in the nominal mirage, and subscribe to stay ahead of the technical shifts we'll be tracking as the Fed makes its move this Wednesday. The world is repricing. Make sure you're on the right side of the ledger.